Hi, I'm Lauren Hamilton, accountant for therapist. Today I want to talk about loans or business loans that you might have taken in order to help support your business financially and how those should be recorded in your accounting because I just recently reviewed someone's accounting who put that in income and wound up filing her tax return and had to pay taxes on that. So let's talk more about that and how you can prevent that happening from your books. Okay, so a lot of you may have, in the beginning, maybe you needed a business loan to get started with your business, or maybe you've even been in practice for a while and you've had some, just things come up where you needed to take a loan for maybe extra cash flow or anything like that. That's a very common thing to happen, so there's no shame or anything around that. However, when that money comes into your bank account, that is not income. So even though money is coming in, and usually anytime money comes into your account, it's considered as, a service income or fees or revenue or anything like that. In this situation is not considered income. And so I want to make sure you're entering that into your accounting system correctly because like I mentioned at the beginning of the video, I have seen where somebody puts it into their income account and then when they went to file their tax return, that amount was in their income account and then therefore taxes were calculated on that amount. So when you have a loan and you get a disbursement from that loan, so let's say you took $25,000 out. I guess rarely are you actually going to get a lump sum of $25,000, and you'll have to look at your loan documents and paperwork for this. But you could have loan fees a part of that. There could be, document fees, bank fees, anything like that, depending on where you're getting this loan from. That could all be built into the loan itself. So even though you took a $25,000 loan out, you may only get $20,000 of that in actual, cash that came into your bank account because the other 5,000 went towards fees and closing costs and all that good stuff. That is part of that. Again, that should be on your loan statement that you would have received at the time of the loan closing. So that way you can calculate all of that correctly. The other part of that is you may have had to calculate your interest all up front. I have seen where like Square, for example, if you took a loan through Square, they calculate what the interest is on that loan over the term of the loan all up front. And so they put all of that in up front. So every time you're making a payment through Square, it's actually just going towards the principal because you've already paid the interest up front. So again, you're going to want to look at your closing documents closely to understand, one, how is interest being calculated? Because if you have a loan that doesn't have interest, then tell us where where you got that loan from. But every loan is going to have interest, so you'll want to have that amount. You'll want to know what the term amount of the loan is. So maybe it's a 3-year, 5-year, 10-year, 15-year loan. So we call that the term amount, and then whatever fees were associated with that loan. So how this breaks out in your accounting system. So you'll have your loan disbursement. So again, let's say you get a lump sum amount and that amount is 20,000, but your actual loan that you applied for was 25,000. So you're actually going to need to create a liability account, and that liability account is going to be on your balance sheet. So think of it as loan, need to pay back. That is a liability. So I am liable for owing that money back to the bank. Whereas when you earn income and money is coming in, that's money that you are collecting as income. So just to kind of distinguish the two. So you're going to have a liability account for this loan, and your liability account total in the beginning is going to be the 25,000. Even though you didn't get 25,000, that is the amount that the bank paid you. I guess in air quotes, because again, they did pay it. It's just that they then had to take out their fees and anything like that. So you're actually probably going to want to do a journal entry for this. And if that scares you, please get help because again, if you do this incorrectly in your books, it could, one, it will have a lasting effect because especially if this loan is being paid out, years, or the term limit is years in the future, then that is going to affect everything that's going forward. So you're going to have a liability account. You're going to put the liability account as a credit. That amount is going to be the $25,000 that the loan was for. Then you are going to debit your bank account for the amount that you actually received in your bank account. So again, if that was $20,000 just for round numbers. So your journal entry is now unbalanced because you have a credit of $25,000 and a debit for $20,000. So the difference is going to be the $5,000 that was paid in fees. So that $5,000 difference is actually going to be a loan origination fee, and that's actually going to be a fixed asset on your books that will have to be amortized over the time of the loan. Otherwise, if it's below $2,500, you can expense that. So if it's legal fees or anything like that, but bank fees, that can go on the income statement. So again, it's really important that you get this set up correctly in the beginning, because if it's not set up right from the beginning, it's going to have a lasting effect for years to come until the loan is actually paid off. So again, the common mistake is when the funds come into your bank account, you put it directly to income. And what happens with that is, again, your income is going to be overstated. So when you go to file your tax return at the end of the year, and you have your income and then all of your expenses and whatever you're left with, your net income, that is what you will be taxed on. So if that loan amount is in that income, then your net income is going to be a lot higher. Therefore, your tax liability is going to be higher. Whereas if it was set up correctly from the beginning, where it was in a liability account and not in your income account, then your income is going to be lower. Therefore, your tax liability is going to be lower. Not only is it going to be lower, it's going to be correct, because you should not have to pay taxes on a loan that you have. The other thing to keep in mind, if the loan is set up correctly on your balance sheet, when you're making a payment towards that loan as it goes into the future, you're going to have what's called a principal and interest payment. So let's say you pay $500 a month to the bank where you have the loan. So within that $500, you could have $300 that is going directly to the loan principal, so that original $25,000 amount, whereas the other $200 could be going towards interest. So you also want to make sure when those payments are coming out monthly that you are splitting that correctly. So you want to make sure that your entry is $300 to the liability account and $200 to the interest expense account. So I see that a lot too, where the whole entire $500 payment would go directly to the liability account. And one, that's not correct, because your liability total at the end of the month is not going to match what the bank has, because the bank is going to show that you only paid $300 in principal, not $500 in principal. The other thing that you're missing is the interest expense. So you can actually count that interest expense as a business deduction. So if you're not capturing that interest expense, then you again could be overstating your income and paying more tax than what you really should be. So again, loans can be a little bit complicated, and especially depending on how the bank processes it, and if there's anything complicated there as far as fees and interest and all that goes. So again, you'll just want to make sure that you're getting it set up correctly at the beginning, and then also capturing those payments correctly as the years go by, that you are making payments on that loan. So a simple way just to kind of end this video topic is to think about, did I earn this or do I owe this? So when money comes into your account, just say to yourself, did I earn this or do I owe this? And if you earned it, that means it's income and it should go on your income statement. And if you owe it, then it is a liability, and that should go towards your balance sheet on the liability account. So again, loans are very common in all businesses, and in, every business goes through a point where a loan might be necessary. So again, the thought of a loan or the idea of a loan shouldn't be anything to, be embarrassed about or shamed about or anything like that. However, from an accounting standpoint, you definitely want to make sure you have it recorded correctly in your books, so that way when your tax preparer goes to prepare your return, they are not capturing anything there that would increase your tax liability unknowingly. So, if you do have a loan and you need help with that, please feel free to reach out to me. I would love to, walk you through that and be able to guide you through that. I hope this information was helpful. If you have any further questions, please let me know. Again, I, want to support therapists in the work that you do, because your work is very important and very needed in our world. So if I can help you there, please let me know. If you did find this video helpful, please like and share it with someone else who might find it helpful as well. We always want to support each other. Until next time, be well.